Welcome to Dezerv's monthly market update. November was a rollercoaster month with multiple events that drove the markets. However, just a few days back, the GDP numbers came out and they were quite concerning. In today's episode, our co-founder Vaibhav Porwal will take us to three important aspects. What's driven the recent market correction, what investors should look out for in the coming few months, and our outlook on different asset classes. Hi Vaibhav.
Hi.
Vaibhav, the Nifty 50 has fallen 8% from its 52-week high, and investors are very concerned. How do you think the markets will recover in the coming few months?
So I wish I could give you the exact timelines. I don't know for sure, but my sense is that it will take 6 to 9 months for the markets to recover, and that recovery will be driven by earning revival. Earnings slowdown was the biggest reason for which markets fell down, and I expect earnings to revive, and which should lead to the recovery of the market also.
And let's dive in a little bit deeper. What are the factors that will drive this earnings growth?
So if you look at the last 6 months, the slowdown in the earnings was at two levels. Government capex had slowed down and private consumption had slowed down. Government capex had slowed down because government was not spending as much money because of elections. We had elections, we had central election, we had state elections. So government spending slowed down. In the month of November, we saw early signs of recovery there. Second factor which led to this slowdown was consumption slowdown. Consumption, private consumption is also expected to revive. We had a very strong monsoon, we had a great festive season, and we are looking forward to a great wedding season also. So all of these factors put together, I think consumption will also see a recovery. Third thing which can assist this recovery is reduction in interest rate. We saw GDP number of 5.4%, and which should give a lot of comfort to RBI in reducing rates. So these three factors put together, my sense is that earnings will revive, and which will help markets to reclaim its previous high.
But Vaibhav, the 5.4% GDP number is very concerning. How do you think that will play out and impact in markets?
So honestly, one thing that I was taught very early is that markets are a leading indicator of the economy. And when markets corrected 10%, there was a feeling that there is a slowdown in the economy. We saw earnings growth also slow down across sectors. It was not limited to one sector. Across sectors, we saw slowdown in the earnings. So some of this slowdown was anticipated, but 5.4% is still lower than what markets were expecting. My view is that with government spending coming back and good consumption pickup, GDP growth will start moving towards 6.5–7%, which should be the trajectory for us. And this slowdown seems to be more a cyclical slowdown than a structural slowdown.
But November has also had a lot of other factors that have pulled the markets down.
In fact, November was a very interesting month. It was a roller coaster ride. But if you zoom out and look at October end market levels and November end market levels, they're almost similar.
Right.
So as if nothing happened, despite too many things happening. And that's how markets are. We had US election, we had Maharashtra state election, we had US Fed meeting, we had India GDP number, US GDP number. So many things happened. But despite that, after all that ups and downs, markets settled at the same levels at which they started. And that's how markets are. Sometimes we need to simply zoom out and look at the bigger picture than to look at these month-on-month events.
Right. And what are the factors that investors should look out for in the coming few months?
So I'll talk about the factors that we are looking at very closely. One thing which is important to look at is the way inflation trajectory is. Despite all the effort, inflation doesn't seem to be coming down in the US. For the month of October, the reading was 0.4%, and which was meaningfully higher than what the markets were expecting. Even in India, we saw inflation of 6% plus, which is higher than what RBI's upper tolerance band is. In India, however, I expect inflation to start inching lower. But in US, there are a lot of uncertainties. And if inflation remains higher, it will curtail Fed's ability to reduce interest rates. So that is something that I'm looking at very closely. Second factor that we are looking at closely is President-elect Trump's policies. We've seen all the announcements around Dodge, announcements around all his appointees. But one thing which is very clear is that he will be very aggressive. So what we witnessed and read yesterday around imposition of tariff on BRICS, if they try and create some alternative to US dollar as a reserve currency, is a sign of things which we can expect from him, which will keep adding volatility to the market. Third, and the last factor that we should look at is India's budget. Budget will give us direction on how our fiscal deficit is shaping up, how government is planning to spend its money, and also if there are any changes in the tax which are proposed for the next financial year. So these are some of the factors that we are looking at very closely.
Right. So keeping in mind the long-term and short-term views, what is your take on different asset classes?
So let's begin with equity first. On equity, I think valuations, especially in large caps, have become reasonable. Current large cap valuations are lower than where they've traded in terms of price to earning ratio over last 5 years. So average of last 5 years is higher than where current valuations are. So obviously that means that markets are reasonably attractive in large caps. Mid and small caps continue to remain expensive. Our focus is much more in large cap. For investors who are looking to invest fresh capital, we recommend investing 40% of their target allocation right away. And remaining they can invest over next 4 months in a staggered manner.
And what about investors who are looking at SIP?
Great time to start SIP. If you're looking to invest money, start right away. You're getting markets 10 to 15% cheaper than where they were 3 months ago.
Right. And what about fixed income?
Fixed income, I think, and maybe we were also expecting rates to come down, but looks like interest rate cut will get delayed. So investors will be better served by investing in up to 2-year maturity paper where they can generate good accruals.
So lock in yield right away instead of waiting.
Yield right away, but maybe there is a little bit of change in stance. Don't go for very high duration papers because, as I said, inflation may not come down in a hurry.
Right. And gold has also touched its all-time high. So what is your take on that?
Gold, I continue to like. Investors should allocate 5 to 7% of their portfolio in gold. And I expect gold to continue to deliver good returns.
Thank you, Vaibhav. That was very insightful. That's all for today's monthly market update. See you in the next episode.